You just struck the match. You are sitting at your kitchen table watching the last mortgage statement you will ever receive turn to ash in a glass ashtray your grandkids made at summer camp. You are 68 years old, the house is paid off, every single penny of equity belongs to you and your spouse. There is no bank on the deed, there is no lien holder, there is no monthly payment draining your checking account. You look across the table at your wife and you say the words every American dreams of saying, "We own this house free and clear." Your kids are calling to congratulate you. Your neighbor brought a bottle of champagne. Your brother-in-law, the one who has been renting for 30 years, is texting you jealous emojis. You feel untouchable. You feel like you beat the system. But what you actually did at that kitchen table was create a situation where substantial tax obligations could arise if not properly managed. You did not fully secure your family's wealth the way you might think. You have locked significant net worth inside a non-liquid asset that carries tax implications you may not understand, and your children could face considerable costs to manage this asset after you pass away. The federal government has a specific code section, Section 121 of the Internal Revenue Code, that protects you and your spouse with a $500,000 capital gains exclusion on your primary residence while you are both alive. That is $500,000 of profit that is excluded from federal capital gains taxation. This is accurate information published by the Internal Revenue Service at irs.gov. But understand what happens at that critical transition point. The instant your spouse dies, the instant you change from filing jointly to filing single, that exclusion collapses. It drops from $500,000 to $250,000 overnight. The IRS did not send a warning letter. There was no phone call. This is the law as written under Section 121 of the Internal Revenue Code. A surviving spouse faces a substantially reduced capital gains exclusion, and this change in tax status occurs automatically. This is not a glitch in the system. This is how the Internal Revenue Code is structured. Understanding these mechanics is essential for retirement planning. I am going to walk you through the mathematics of this situation. I will show you how a house you bought for $150,000 in 1995 that is now worth over $1 million creates specific tax consequences in your retirement portfolio. I'm going to demonstrate how your required minimum distributions from your IRA affect your tax brackets when you become a single filer, and I'm going to provide you with accurate information about strategies that qualified estate planning attorneys use when advising clients facing these situations. Let me tell you about Robert and Susan Caldwell. Robert and Susan bought a 3-bedroom ranch in a suburb outside Columbus, Ohio in 1995. They paid $150,000. Robert was a mechanical engineer. Susan was a school administrator. They raised 2 children in that house. They installed a new roof in 2008. They finished the basement in 2012. They refinanced once in 2004. And then they spent the next 20 years paying down their mortgage to zero. In 2024, their mortgage was fully paid. In 2026, after 3 years of continued appreciation in the Columbus metropolitan area, their home appraised at $1,150,000. Robert and Susan Caldwell have $1 million of equity in their home, and they believe this is their most significant financial asset. This is accurate. However, substantial tax considerations apply. Here is important disclosure information. Tax law is complex. Estate planning has legal dimensions that require professional advice. If you want personalized guidance, you should consult with a qualified tax professional, a CPA with expertise in capital gains taxation, or an attorney who specializes in estate planning and understands Section 1014 and Section 121 of the Internal Revenue Code. What follows is educational information about how these code sections operate. This is not personal tax advice. Let me address the 3 layers of tax consequences, because this is not one issue. This involves multiple interconnected tax considerations. Layer 1, the Section 121 capital gains exclusion under IRS Code. Section 121, if you sell your primary residence, you can exclude up to $250,000 of capital gains from federal income tax if you are a single filer, or up to $500,000 if you are married filing jointly. You must have owned and lived in the home for at least 2 out of the 5 years before the sale. This information is published on irs.gov and is current as of 2026. For Robert and Susan, while both are alive and filing jointly, this operates favorably. They have $1 million of profit. The $500,000 exclusion applies. That means $500,000 of their profit is excluded from federal taxation. The remaining $500,000 is subject to capital gains taxation as a long-term capital gain. At the 2026 federal long-term capital gains rate of 15%, that calculates to $75,000 in federal tax. Additionally, the 3.8% net investment income tax applies because their modified adjusted gross income exceeds the $250,000 threshold for joint filers. This adds approximately $19,000. Ohio state income tax on capital gains is applied at approximately 3.5%. This adds approximately $17,500. The combined state and federal tax liability approximates $110,000. This is a substantial amount, but manageable if planned appropriately. Now, Susan passes away in March of 2027. Robert is 73 years old. The house is no longer practical for his needs. He decides he wants to sell and move closer to his daughter in North Carolina. But Robert is now a single filer. Under Section 121 of the Internal Revenue Code, his exclusion drops from $500,000 to $250,000. Many tax professionals will calculate his taxable gain as $750,000 at this point in the analysis. However, this analysis is incomplete. Two critical provisions of federal tax law apply when Susan dies. First is the step-up in basis. Under IRC Section 1014, when a property owner passes away, the property receives what is called a step-up in basis to its fair market value on the date of death. The state property law system you live under determines how this works in practice. Ohio is a common law property state, not a community property state. This distinction significantly affects the outcome. In a common law state like Ohio, only the deceased spouse's share of jointly held property receives the step-up in basis to fair market value. So Susan's half of the home, which had an original basis of $75,000 when they purchased the property in 1995, steps up to $575,000, which is half of the $1,150,000 current appraised value. Robert's half kept its original basis of $75,000. His new combined basis is now $650,000. If Robert sells the property shortly after Susan's death for $1,150,000, his gain would be $500,000, not $1 million. This step-up in basis substantially changes the tax calculation. Second is the surviving spouse election under Section 121. Under Section 121(b)(4) of the Internal Revenue Code, a surviving spouse who sells the home within 2 years of the date of death of their spouse can apply the full $500,000 married filing jointly capital gains exclusion when selling the property, even though they are technically filing as single. The ownership and use test must have been satisfied while both spouses were alive. Robert has a 2-year window from Susan's date of death. If he sells within 2 years, his calculation changes significantly. His gain is $500,000. His available exclusion is $500,000. His taxable capital gain is $0. He sells the house, receives $1,150,000, pays $0 capital gains tax, and retains the full proceeds. But here is the critical issue. What if Robert does not know about the 2-year window? What if his tax professional advises him to wait and see? What if he is grieving and cannot make decisions? What if it takes him 3 years to finally list the property? The 2-year window closes. Now Robert sells for $1,150,000 with a basis of $650,000. His gain is $500,000. His single filer exclusion is $250,000. That leaves $250,000 of taxable long-term capital gain. At the federal rate of 15%, this is $37,500. The 3.8% NIIT adds another $9,500. Ohio state tax at 3.5% adds another $8,750. Robert faces a total tax liability of approximately $55,000 to $60,000 because a deadline passed and the tax consequence changed substantially. Layer 2, required minimum distribution compression. The second layer involves how other income sources interact with capital gains taxation. When Susan was alive, Robert and Susan filed jointly. The 2026 married filing jointly tax brackets provided substantial room. The 12% federal income tax bracket for joint filers extends to $96,950. The 22% bracket extends to $206,700. For a retired couple receiving Social Security, plus required minimum distributions from IRAs, these brackets provide significant tax planning flexibility. The moment Susan dies, Robert becomes a single filer. The 12% bracket for a single filer tops out at $48,475. The 22% bracket tops out at $103,350. The brackets are compressed significantly, but Robert's income did not shrink proportionally. His IRA balance did not disappear. His required minimum distributions continue. If anything, Robert inherited Susan's IRA, and his combined RMD obligations increased. Consider Robert's tax situation the year after Susan's death. Robert is 74 years old. He has his own IRA worth $600,000. He inherited Susan's IRA worth $250,000. Under IRS tables, his combined required minimum distribution is approximately $35,400 annually. His Social Security benefit is $32,000. His total gross income is $67,400 as a single filer. His standard deduction as a single filer is $16,100. The additional deduction for being over 65 is $2,050. The senior deduction available under the One Big Beautiful Bill Act of 2025 provides another $6,000 for certain single filers. His total deductions are $24,150. His taxable ordinary income is $43,250. Now consider what happens if Robert sells the home in 2029 after the 2-year window expires. By 2029, the home has appreciated to $1,200,000. His gain is $550,000. His basis remains $650,000. His single filer capital gains exclusion covers $250,000. That leaves $300,000 of taxable long-term capital gains. His ordinary income of $43,250 has already consumed a substantial portion of the 0% capital gains bracket for single filers, which extends to $49,450. Nearly all of his $300,000 in capital gains will be taxed at the 15% federal rate. This calculates to $45,000 in federal capital gains tax. The 3.8% net investment income tax adds approximately $12,000. Ohio state tax adds approximately $14,000. Probate fees in Ohio under the statutory fee schedule amount to approximately $30,000 to $35,000. Robert's total financial impact from this situation is approximately $100,000. Layer 3. Community property, treatment, and trust structures. The third layer involves a significant distinction between different state property law systems. Everything described about Robert and Susan happened in Ohio, a common law property state. In Ohio, when Susan died, only her half of the house received the step-up in basis. Robert's half kept its original basis from 1995. This is the default system in 41 states. However, 9 states operate under a completely different system called community property. These states are Arizona, California, Idaho, Louisiana, Nevada, New Mexico, Texas, Washington, and Wisconsin. In these states, when one spouse dies, both halves of jointly held property receive what is called a full step-up in basis to fair market value under IRC Section 1014B(6). Not just the deceased spouse's share, the entire property resets to fair market value on the date of death. Consider the same situation in Arizona instead of Ohio. Robert and Susan purchased the same property in 1995 for $150,000. It is now worth $1,150,000. Susan dies. Under Arizona community property law, the entire home receives a step-up in basis to $1,150,000. Robert's new basis is $1,150,000. If he sells immediately for $1,150,000, his gain is zero. His federal tax liability is zero. He does not require the Section 121 exclusion because the step-up eliminated the gain entirely. He receives the full $1,150,000 in proceeds without federal capital gains tax. The tax difference between Ohio and Arizona on this identical house with identical circumstances is approximately $60,000. This is the cost of geography. This is the cost of not understanding state property law systems. 5 states have recently enacted statutes that provide an additional option. Alaska, Florida, Kentucky, South Dakota, and Tennessee allow married couples to create what is called a community property trust. These trusts allow couples living in common law states to opt into community property treatment for assets placed inside the trust. If Robert and Susan had lived in Florida and established a Florida Community Property Trust, which has been available since July 1st, 2021, under the Florida Community Property Trust Act, the assets inside that trust would be treated as community property for federal income tax purposes under Section 1014B(6). When Susan died, the entire home would have received the full double step-up in basis. Robert would have owed zero in capital gains tax on the property sale. The legal framework allows a married couple living in a common law state to establish a community property trust in one of these opt-in states with a qualified trustee in that state, transfer the title of their home into that trust, and potentially qualify for full community property step-up treatment when the first spouse passes away. The IRS has not issued formal guidance specifically addressing this treatment for opt-in states, and no federal court has directly ruled on the question. However, the legal argument is grounded in the principle that federal tax law defers to state law for determining property rights. If property is classified as community property under the law of the state governing the trust, the statutory requirements of Section 1014B(6) are arguably satisfied. This is not a tax loophole or an illegal strategy. This is a statutory option that multiple states enacted specifically to provide estate planning alternatives. However, professional guidance is essential. The planning must occur while both spouses are living. The trust must be properly established with a qualified trustee. The property title must be transferred into the trust. Professional help is necessary. Let me provide a state comparison showing 3 different outcomes with the same property and timeline. Florida scenario. Margaret and Thomas Patterson live in Florida. They purchased their house in 1998 for $175,000. In 2026, the property is worth $1,300,000. They have $1,125,000 of equity. In 2022, an estate planning attorney established a Florida Community Property Trust. The home title was properly transferred into the trust. Thomas passes away in 2027. Because the home was held in a community property trust, the entire property receives the full step-up in basis to $1,300,000 under Section 1014B(6). Margaret decides to sell and move into a retirement community. She sells for $1,300,000. Her gain is zero. Her federal capital gains tax is zero. Florida has no state income tax, so her state tax is zero. The home was in a funded trust, so probate is not required. Margaret walks away with $1,300,000 in proceeds without paying capital gains taxes. Ohio scenario. Charles and Diane Harper live in Ohio. Same purchase year, 1998. Same appreciation pattern. They did not establish any trust structure. Charles passes away in 2027. Only as half of the property receives the step-up in basis. Diane waits 3 years to sell because she is grieving and uncertain about the process. She misses the 2-year window under Section 121(b)(4). She sells in 2030 for $1,350,000. Her basis is approximately $700,000, reflecting the step-up on Charles's half. Her gain is $650,000. Her single filer exclusion under Section 121 is $250,000. That leaves $400,000 of taxable capital gain. Federal capital gains tax at 15% is $60,000. The 3.8% NIIT adds approximately $12,000. Ohio state income tax adds approximately $14,000. Ohio probate fees on a $1,350,000 estate are $30,000 to $35,000. Diane's total cost is approximately $120,000. California. Scenario. Patricia and James Chen live in California. Same purchase date and appreciation. California is a community property state by default. James passes away in 2027. Under California law, the entire home receives the full step-up in basis automatically. Patricia sells for $1,350,000. The home appreciates like the other state's properties. Her gain is zero for federal purposes because of the step-up. California taxes capital gains as ordinary income at rates up to 13.3%. But with a zero gain, there is no tax. Patricia retains the full proceeds. 3 different families, same love story, same house, same decades of work. Margaret paid $0. Diane paid $120,000. Patricia paid $0. The difference is knowledge and planning. The difference is understanding Section 1014(b)(6) and how different state systems apply it. Concrete action steps. Step 1. Calculate your basis and document improvements. Obtain your original purchase documents. Identify every capital improvement you have made. New roof, kitchen renovation, HVAC system replacement, basement finishing, new windows, plumbing upgrades. These are deductible additions to your basis. If you purchased for $150,000 and spent $75,000 on documented improvements over 30 years, your adjusted basis is $225,000, not $150,000. That $75,000 in documented improvements reduces your taxable gain by $75,000. At the 15% federal capital gains rate, this saves approximately $11,250 in federal tax. However, you need receipts, you need documentation. Gather these records now while you can locate them. Step 2. Determine your state property system. Verify whether your state is a community property state or a common law property state. If you live in Arizona, California, Idaho, Louisiana, Nevada, New Mexico, Texas, Washington, or Wisconsin, you are in a community property state. You will automatically receive the full step-up in basis when the first spouse dies. If you live in any other state, you are in a common law property state. Only the deceased spouse's share receives the step-up. Your planning approach differs accordingly. Step 3. Evaluate community property trust options in your state. If you live in a common law state, research whether your state is one of the 5 opt-in states. Florida, effective July 1st, 2021, Alaska, Kentucky, South Dakota, or Tennessee. If so, consult with a qualified estate planning attorney licensed in that state about establishing a community property trust. The planning must happen while both spouses are alive. The property title must be transferred into the trust. The trust must have a qualified trustee in the state where it is created. This is professional legal work requiring expertise. Attorneys specializing in this work typically charge $3,000 to $7,000 for the structure. The cost of not doing this, based on the examples provided, is $60,000 to $100,000. The mathematics clearly indicate this is a worthwhile investment for families with substantial home equity. Step 4. Establish a revocable living trust. A revocable living trust does not create the step-up in basis. That happens automatically under Section 1014 when death occurs. What a revocable living trust accomplishes is avoiding probate court. Probate is a public legal process that is slow and expensive. In Ohio, statutory probate fees on a $1,200,000 estate exceed $30,000. In California, combined executor and attorney probate fees on an identical estate approach $46,000. In Florida, a properly funded revocable living trust bypasses probate entirely. The trust itself costs approximately $2,000 to establish. Probate could cost $10,000 to $50,000. This is not a marginal decision. Step 5. Understand the Section 121(b)(4) 2-year window. If your spouse dies, you have a 2-year window from the date of death within which you can sell the home and still claim the full $500,000 married filing jointly capital gains exclusion under Section 121(b)(4), even though you are filing as a single person. The ownership and use tests must have been satisfied while your spouse was alive. If your spouse passed within the last 2 years and you are considering selling, consult a tax professional immediately. That timeline is critical, and the tax consequences of missing it are substantial. Step 6. Coordinate home sale timing with income and tax bracket strategy. If you are a surviving spouse with required minimum distributions pushing you into higher tax brackets, the capital gains from a home sale create additional tax complications. Your long-term capital gains rate depends on your total taxable income, including ordinary income from Social Security and IRA distributions. If your ordinary income already consumed the 0% capital gains bracket, additional capital gains are taxed at 15% or higher. A qualified tax professional can help evaluate whether timing the sale across multiple tax years is beneficial. Installment sales under Section 453 of the Internal Revenue Code might reduce your income spike in any single year. Strategic Roth conversions in the years before a home sale might reduce future RMD income and create more room in the lower capital gains brackets. The final point. You now understand the mechanics of how Section 121 and Section 1014(b)(6) operate, how different state property systems create vastly different tax outcomes, and how the 2-year window under Section 121(b)(4) creates urgency for surviving spouses considering home sales. You understand how required minimum distributions compound the tax consequences when capital gains stack on top of ordinary income. You know that the cost of not planning is real. $60,000 to $100,000 is not a theoretical number, but knowledge without action is procrastination. The phone call from the hospital comes, the grief makes decisions impossible, the 2-year window closes, the probate filing begins, and by then, the opportunity has passed. Pull your property deed today. Look at how the property is titled. Is it in joint tenancy? Is it in tenancy by the entirety? Is it in one spouse's name? Is it in a trust? If you do not know the answer, you have work to do, and the longer you wait, the more expensive that work becomes. Consult the resources published by the Internal Revenue Service at irs.gov for official information about Section 121 and Section 1014. Consult your state's Secretary of State office for information about whether your state is a community property state. If you are in an opt-in state for community property trusts, research your state's statute. Consult with a qualified estate planning attorney about your specific situation and options available under your state's law. The structure around your house is what protects your family. That structure must be built now, while both spouses are living, while you have time to plan. Not after diagnosis, not after funeral, now.